So what strategies are you employing to identify these potential high net worth real estate clients and the need of their life insurance?
So we talk about the life cycle of it, and I mentioned it a second ago. Of the first step is income replacement, and you mentioned families that have significant assets but have a little bit of a liquidity issue. If you pass, and you might even not have a significant taxable situation, you're just used to living off of $50,000 a month, and all of a sudden something happens. You have a situation, a bad deal, or a tragic event. The family's going to need income replacement. And the second that you walk out that door and don't come back, we can't replace you, but a tax-free check given to your financial advisor. We generally talk about what is the annual spending of the family. All right, multiply that number. Say that, Roccanti family spends, $20,000 a month. Okay. So that's around $250,000 a year times 20 would be $5 million. If $5 million were given to your financial advisor, they could create 5% distributions on that money nearly conservatively and into perpetuity. If we can achieve that, now we feel pretty solid that the family is going to be okay for income replacement reasons. If you say, Jeff, that's very nice, we're well past that. Now we convert that policy into something permanent that we can grow cash value in. At which point we say, okay, how much is in your SEP? How much is in all of your qualified accounts combined? What does it look like you're going to be pulling in retirement from that you still have to show on a 1040 or from a brokerage account that's still going to be taxable? Okay. As we look at those high, tax brackets, now if we can reduce that by pulling from a life insurance policy, that sort of deferred comp idea, life insurance for retirement planning, all those things come into play as we overfund, permanent life insurance policies. And then the next stage is what we've already discussed is, I'm getting to my 50s and 60s. Things are just going amazingly for my business. And I say to my advisors, that, 30K, 50K a month is cute, but we're in a whole different stratosphere now. I say, okay, great. Well, it's time for you to move that policy into an ILET so that it's not ballooning your estate further and it can be used by your beneficiaries for liquidity purposes. And that's kind of the life cycle of the entire process with our clients.
Can you walk us through maybe a successful case that you tailored life insurance to meet the unique needs and goals of one of your clients, your high
Yeah,
net worth clients, individuals or families?
100%. And we had one recently where you don't often see a $100 million term policy, but guess what? They were in negotiations and advanced negotiations for selling their company. They knew that they were about to receive the better part of $500 million and was going to need significant liquidity, but didn't have it yet. So overfunding this thing or funding to a guaranteed permanent life insurance policy when you haven't sold your company yet would really hamstrung the family. So we got through underwriting. Took a couple different carriers and reinsurance to get that level of underwriting. The ILET was put in place by the trust and estate attorney that brought the client to us. And then we waited for the deal to close. Once the deal closed, we converted the policy to permanent life insurance. And now the beneficiaries in the family have, $100 million of permanent life insurance waiting for them whenever, they pass to pay off the service. So we are often brought in as just a seat at the table. We say that our scope is 2 inches wide and 7 miles deep. I myself am a CFP. I have a master's degree. I can create a portfolio for you tomorrow. We don't do it. We like working with RIAs. We like working with multifamily offices because we swim in our lane and we will not, mention a thing as far as wealth management. We leave that to the professionals, on the client's team.
You mentioned ILET. Can you
Yep.
quickly explain to people who maybe don't know what that is, what an ILET is?
Right. The Irrevocable Life Insurance Trust. And so there are many different versions of how you're going to put assets outside of your estate. So if I know that my family can live off of, $10 million, if I'm 70 years old, we've been living well, I have all the Ferraris I need and all the boats I need, and I have all the properties I need, I probably would live off about $10 million the rest of my days and still dance in my golden years. I want everything else out of my estate that I possibly can. I want to take control away from myself, from my assets. I can only do that, to the tune of $26 million on these appreciated assets that, as good as some of my accounting folks are, we can only take discounts on so many things after they've appreciated so much. Now, what are we going to do? Well, I don't want my personally held life insurance to balloon my estate. If I own my life insurance in my own name, all of a sudden, the $10 million I have left to my name could also have a $20 million policy with it. Well, guess what? I would receive that completely income tax free after I passed, but it would still go towards my estate tax because I've gone past my limits. So
Right.
anyone that is starting to get to that stage of life where they're speaking with their trusted estate attorney, you need to ask that question. Do I still own a life insurance policy personally? If I do, it might be time to start talking about moving it to an ILET. And there are significantly efficient ways that we've advocated to do it, where sometimes you take a note back, sometimes you have an uncompleted gift. There are all sorts of ways, depending on the situation for each client, where it's done in the most appropriate way so that you're not creating a large gift when you do it.
Right. So the $26 million that Jeff is talking about, that's kind of the estate or inheritance tax threshold currently
For
under
a married
law.
couple.
So basically, if your family has net worth over that, or it's going to be over that, that's usually where you're going to have estate planning problems. And this is where life insurance could be a tool that you could use, but you really need to be talking to an estate attorney at that point if you're having it. What some people don't know is that the current tax law is actually sunsetting in 2026 back to the old law. That means that when the new law came, it doubled the inheritance tax threshold to 26. It's going to go back down to 13 million basically in a couple years here in 2026. And so then that threshold jumps a lot. I mean, $13 million, that's still a lot for a lot of people. But the reality is that most of these high net worth people easily will have $13 million and really need to start focusing on estate planning. I would say before 2026, if you're going to talk to a state attorney, and talk to them now because they're all
Yep.
going to be super busy in 2025. So do not wait till 2025. And then this is where maybe something like life insurance can help you. We don't know what's going to happen with the tax law. They could change it. They could keep it at 2026. They could make it increase it. All we know is under the current law, it's 2026. It's going to drop down to 13 million in
Right.
2026.
And as that window gets smaller of, okay, I need it for income replacement because if I don't show up, we don't have enough assets saved in the family that my family can stay at the same clubs and the same schools and everything else without dad's income coming or mom's income coming home. Okay, that goes up and up and up as we need it more. But as the window for estate planning comes down, now it's like there's almost nobody left that can self-insure and you have liquidity. Real estate families, closely held businesses, they don't have that liquidity. They have that asset value, but there's very few people left that can self-insure, as they like to say, where they don't need life insurance for income replacement and they're not quite rich enough that they need it for estate planning. That window is getting smaller and smaller by the day. To your point about speaking with a trusted estate attorney now, don't try and run out of a theater when someone screams fire. What kind of offer do you think you're going to get from an insurance company in December of 2025 when your blood work says, oh yeah, it looks like you saw a cardiologist 3 years ago? Yeah, it was nothing. I was concerned because I got nervous on a flight once. And like, well, we got 100,000 other applications behind you. So here's your standard offer, take it or leave it.
Right.
I can only do so much as a fiduciary to paper the account appropriately and make you look as attractive to every single carrier as I can. We do internal underwriting at our firm, which means your name is redacted, your social security is redacted, and a handful of the biggest carriers are going to compete for your business. And they're going to say, given this APS and medical records, this height and weight, what would you offer this? And if they all compete for your business, we have an opportunity to really do some great things. And as a fiduciary, we win business that way versus other wholesalers that just say, well, my software said that Pacific Life is going to be the best, or John Hancock's going to be the best. So let's just put in an application. Like, there's a better job to be done here. If I walked out of my house today and handed you the keys and say, sell the
Yeah.
thing, it'd be fine. But if there's a water spot behind me and you walked in with a report from an inspector saying there's no mold, there's no roof damage, we do see that there's paint, it's going to require about $25,000 of work. Would you like me to take 25 grand off the contract, or would you like to just handle it yourself? Now you get a little bit of confidence that we've addressed everything. When we're talking about life insurance underwriting, it's the same exact thing. I'm going to request your records. I'm going to look through for all the bogeys and red flags that we've seen before. I'm going to call up those doctors, get a note that addresses it, that, yes, I saw him. There's no further monitoring necessary. And all of a sudden, we properly paper the account to get you the best offer we can.
Keep it on this subject. I mean, you already kind of mentioned a few of these right here, but what are some of the most common misconceptions and mistakes that you see when it comes to life insurance?
So there's a very low barrier to entry in my industry. So there's such an opportunity to do the job better. Why do I kind of throw shade at it? Because everybody, not everyone, a lot of people know a situation where an insurance company didn't pay, or what happened. I thought I paid into this thing for multiple decades. How did I get a cash call when I was 84 years old for $100,000, or the life insurance won't pay? Why do these nightmares happen? And the nightmare happens because these policies aren't serviced. That it's very easy to sell a policy, and then either the salesman is retired or out of the industry or otherwise, and nobody is checking on it. Well, you had a 2-decade period of lower for longer interest rates, and the general account of all these major mutual insurance carriers went down significantly. So the illustration you had back in 2004 doesn't match at all the cash value you had. And if you had a couple payments that were late, or caused a lapse that was brought the policy back into force, all of a sudden your death benefit might not be guaranteed. If nobody's asked these questions, if no one's asked for in-force valuation, how many people I say, when's the last time your policy was reviewed? And say, why would it be reviewed? I thought it was set it and forget it. It says guaranteed at the top, like Tommy Boy. It says guaranteed on the box. What's the problem?
That's right.
And this is the opportunity to do the job better. And it's not rocket science. All these things I'm discussing today, they are complicated. But if you sit down and you read the contract and you ask the questions of the carriers, are these things still in force? Are these guarantees still in there? How much cash value will they have if they take out X, Y, and Z amount? Then you can get to a very quick and honest answer that most people can understand. But if you don't have a fiduciary asking questions on your behalf and reviewing it annually with you, then you can end up in a very bad place, because as you model out and extrapolate a lower interest rate or a higher cost of insurance than expected, all of a sudden you're in a terrible place. So there's just such an opportunity from our end to be a fiduciary for our advisors and eventually our policyholders.
Yeah, I love the Tommy Boy reference. For me individually, I was like, oh, that's a good reference from Jeff there. So let's move into some more of these actual issues. So probably some people maybe have heard of the term like life insurance premium financing.
Yep.
Can you give us a little bit more into what that actually is?
So developers, real estate professionals are very, very, very comfortable with leverage. They know how to model their projects. They know what they're comfortable with, and they become very comfortable with earning the spread between whatever we are going to make on revenue and what we're going to owe to the bank against it. And if we can create a high enough spread in our behalf, that arbitrage is going to line our pockets, and they become comfortable with it. Premium financing works in a very similar way, third-party premium financing, where I'm going to have a bank. I'm going to borrow a note from the bank. The bank is going to pay the insurance carrier my premium. Now, as long as that note is at a lower interest rate than whatever I'm receiving from the insurance carrier on my cash value, then that arbitrage works, significantly well for me. And you'll see some illustrations from especially 5-10 years ago where individuals basically thought they were going to get free life insurance. If I borrow at 3% and this grows at 7%, then in 10 or 15 years, I'm going to have such a significant amount of cash value built up in there, I could pay off the loan to the bank with my cash value, and net out of pocket, I've paid nothing. This is fantastic. Well, what could happen? What could go wrong? You have a variable rate on the loan. So now we're sitting here at 7.5% on a mortgage, probably a little bit higher of a premium for premium financing arrangement. If you're still receiving the same 5 or 6% in the general account, in the whole life account, you might be in a spot where your arbitrage is flipped upside down, and you're not really certain why you bought this in the first place. Because if it wasn't free, I didn't know why I needed it for estate planning. I didn't really want to have this if I was going to be paying out of pocket or I don't have the liquidity for it. So these premium financing arrangements are the same as many, many other business deals. Charlie Munger and Warren Buffett used to say there's only three ways that a smart person goes broke: ladies, liquor, and leverage. Then Warren says the first two aren't anywhere near it. It's really just leverage. And that's all you're doing is you're creating a leverage situation where if I have a construction company that I am returning year after year, high teens amount of return on my investment or return on equity, why would I want to turn off the golden goose or take money out of that operation for a life insurance policy? At that point, it makes a lot of sense to use a premium financing arrangement where I can borrow far cheaper than what I can use and earn on my money. So that makes sense, but just make sure that you have enough money to write a big check if things go awry. You don't just want to be so leveraged where should anything go wrong, the thing's going to lapse, it's going to terminate, I'm going to have a big problem on my hands. The biggest issue we see with it is if someone has taken a significant amount of money out. So imagine now I have a $5 million policy. I've generated $3 million of cash value. I've only paid in $1 million of premium and the rest is growth. Okay, fine. So I withdraw up to my cost basis and I take a loan for another 1.5 against it. So net, I have $1 million in, $2.5 million out. As long as the policy stays in force until the day I die and the loan is extinguished by the death benefit, we're all good. But should this lapse or terminate while I'm alive, where you say, I don't care about that policy anymore. My kids are grown. I sold my company. I don't need the life insurance the way I thought I would. Guess what? The IRS says we have a closed transaction. You have $1 million in, you have $2.5 million out. Pay me my gains on $1.5 million.
Right.
And so you want to be careful anytime that you are getting pretty close to closing the transaction. So as long as everything stays alive or you have a cash reserve to pay any cash call necessary for the insurance premium, then absolutely, you might make a lot of sense for you. But when a salesman walks in with an illustration that shows free insurance, this huge arbitrage, that's where you kind of smell a rat.
Yeah, I mean, most real estate investors are used to leverage. They understand that leverage is a double-edged sword. It can make you a lot of money or lose you a lot of money. But this is one of those great strategies where it's like it's not gonna be right for everyone. But it might be a really, really good one, especially if you don't want to liquidate any assets to pay these premiums. And again, you're loaning money, so this is not income. It's not creating any kind of taxable event there. So these are a few good strategies that potentially for investors, especially if you really care about your ROI, because like you were kind of saying before, basically if you think you can get a higher ROI in the life insurance policy than what you're loaning the money, you're making money by not using any of your own money. Okay. That's what real estate people love. They love investing in real estate, put no money of their own money down, but yet they still are making a return. So this is just a good strategy, a good tool to have. It might be something that fits your strategy. Let's move on to buy-sell arrangements. So, a buy-sell arrangement, this is more like a legal business contract that basically stipulates how a partner's share of the business may be reassigned if the partner dies or leaves. So basically, it's triggering these buyout events. Okay. So, the most common ones you'll see is like a cross-purchase agreement or an entity purchase. So cross-purchase agreement basically means that the remaining owners can buy out the partner that dies or leaves. The entity purchase or redemption basically says the business entity has to buy them out. Because a lot of times what these things are doing is they're restricting owners from selling to outside investors. So, and like a very simple, illustration here is two business partners, they start a partnership. Run a business. Unfortunately, life happens, one passes away, but they were both super valuable to this organization. Okay. Of course, when someone dies, they leave it to their family. Their family might be great people, but they didn't run the business. Okay. And they're probably most likely going to want liquidity. They're going to want their money out of the deal. And so this is just basically a contract, that basically says, okay, when something happens like this, all right, how can we do this? Because I don't want to sell half my business to someone I don't know to investors that I don't know, because the family, I just, they're not used to running the business. They just want to get the money that the business is worth. So a lot of times there's basically establishing a method of evaluation that happens in these contracts. Be a lot of things: times revenue, earnings multiplier, discounted cash flow method, book value, liquidation value. These are all different methods, but this agreement spells it out. Okay. Basically, all right, what's the options we have when someone dies or leaves? What's the valuation that we can have so we can see what basically the buyout is for that ownership percentage? Okay. So then how, Jeff, can we use life insurance with these buy-sell arrangements to solve this problem?
So, to the overarching theme of this conversation, it's liquidity on demand. When the two of us formed our business arrangement together, and we started our landscaping business, and now we're up to 200 trucks, we never imagined we would be where we are today. You know better than anyone the art and the science of valuation, especially when you're talking about a development or a real estate project, something that's not cash flowing yet. The difference in ways that you can value these things to create an excessive valuation or draw it all the way down for any given purpose is extreme. And that's how you end up in litigation for a long time. So the first thing we advocate is method evaluation. That the two of us love each other right now. Everything is going so great. If we are going to agree that upon my tragic death, Amanda is going to be bought out of my shares, then we need to determine how my shares are going to be valued at that time. And if we can determine that, kind of the cadence of how often we want evaluation or don't want evaluation. And the final piece is, are we valuing it as of yesterday when Jeff was alive, or tomorrow when Jeff has passed? Because his relationship and expertise might be significant to the valuation of that company. So if we can kind of get those basic things spelled out between each other, then we're on our way to a good buy-sell arrangement. Now, where life insurance comes in handy is if we have a project that we are funding with investor capital, with everything that we have, and I pass, and we've determined that Daniel needs to come up with $10 million overnight, I don't really know a great way to do it. And if my wife is not taken seriously, she might, issue a cease and desist order until you figure out how to pay what she feels she's owed. Now, it's not always that extreme, but realize you've signed your name to a legal contract, something you formulated yourself and agreed to. So oftentimes we'll see underfunded or completely unfunded buy-sell agreements where, our landscaping business started with 2 trucks and we bought $1 million term policy on each other. Now we have 200 trucks and a $20 million valuation for the company. So we should have updated the number of policies or the amount of coverage on each other long ago, just kind of on the cadence. Anytime you hear the words new valuation as a fiduciary, as a CPA, or as a business owner, if we have a new valuation, we better make sure that we either amend our agreement or we amend the policies that fund the agreement. Because if you don't, and a tragedy strikes, you could really end up in a bad spot for the company. You could be existential risk for a little while.
Yeah, so basically what Jeff is saying is this can be a funding instrument. So unfortunately, you don't know when anyone's going to pass away. Someone does. Like you're saying, there's a big expense now, $10 million or something, to buy out the other partner that passed away shares from their family. Because now it's like, what, it's my business. They don't want to run it. I just want to own the business whole by myself. Well, I don't have $10 million because all my assets are illiquid, basically. It's in the business and things like that. So by basically putting an insurance policy on each other as you being the beneficiary, now that person passes away, now I have cash that is tax-free, because remember, death benefit is tax-free. So now I have a tax-free cash to go turn around and purchase basically the other partner's shares. So that we can own the company, because it's really about control. And also, like you were saying, and then creating basically, so you're not having tax consequences here, where I'd say maybe I have it, but it's all in like stocks. Well, now I got to turn around and sell the stocks. Who knows how much, taxes now I got to pay on those stocks to buy it. So it's basically minimizing the tax consequences in this situation, life insurance can use that and keep control of your business.
Yeah. Or you have to borrow against the company. All of a sudden, the
Yep.
remaining member that's not going to own 100% of the company. Well, yeah, but you're leveraged every bit of the company and against just to create this payout and distribution. So there's a lot of bad options after a terrible event where the company is grieving, a little bit listless, and you need some ideas of how to get there. This is where we help. The
Right.
final piece on this is we've seen a fairly robust life settlement market where we sell our company. I own a $5 million term policy on Daniel's life. Daniel's not my CFO anymore. So what do I really need to keep paying premiums for an insurance policy on his life for? Shouldn't I just let it go? I mean, the term policy doesn't carry any cash value or anything. Well, guess what? Unfortunately, Daniel is not a spring chicken anymore, and he's actually not that healthy. There's a significant market where, guess what? The conversion privileges within that term policy allow it to be turned into a permanent policy. And the life settlement market and private equity groups that are bidding on it are significantly interested. They don't think they're going to have to pay premiums on Daniel's life for more than 10 more years. Sorry, Daniel. But it's a life insurance conversation. Had to happen. And they think, all right, $5 million here, 10 years of $100,000 premiums. Okay. I can bid, in that case, it was $1.4 million for a term policy that the guys were just going to let lapse. As a fiduciary and as an advisor, they expect you to do all the cost segs every year and find all the tax advantages every year because that's what they pay you to do. But if you find this life settlement money between the couch cushions for someone, my goodness, they will shout your names from the tee box forever, just because you went out of their way for them and really found that you protected them when they needed it. And then you found money on the other side of it. It's really can be a significant gain. Just it's a lesson not to let anything lapse or terminate without making a phone call and seeing what options you have.
That's good. Hopefully, I have more than 10 years. I think my family would be not happy if I had 10 years left. Uh, but I mean, basically, what we're talking about here is, life insurance. It's exactly what it says. It's a payout usually when somebody passes away. That's a very emotional experience. It's not a good time for anyone when anyone passes away. But then there's all this whole financial side. I have to deal with it a lot of times on the tax side. Someone passes away, they don't want to talk about finance, they don't want to talk about money, and then there's all these problems. And if they didn't plan for it, it's worse. You know, let's make it as easy as possible so that when someone passes away, that whatever they're leaving to the next generation or the business or whatever it is, there's already a plan in place. It's easy for your beneficiary, it's easy for your heirs, it's easy for your business partners to just pick up, move on from there. And this is where life insurance can really help. So is there any other problems, Jeff, that like life insurance can be a solution specifically for like real estate investors and operators?
There are plenty. These are tools, and every situation is different. Whether it's disability planning for buyouts, whether it is strictly life insurance, long-term care, there are all sorts of ways that we can use the tool. I'm sure that many of your viewers watch, whether it's called Twitter or X or Instagram or whatever, and see all the different hacks out there for different ways to use tools, different ways to use things you find around the house. Find out from your professionals what you have available to you, and then you can make the best decision you want between how old am I, what's my health like, what's my liquidity like, what do I want to put outside my estate, what's my trust and estate advisor advising I do to protect the company and protect my family. The more options we can bring to the table for you, the better a decision you can make, and the more options you can have, because we don't know what life is going to throw our way. So we just try and find the most tax efficient way to give you options. If we can do that, we've done our job.
Yeah, you're right, Jeff. I mean, the solution is unique to you. Not any two people are the same solution. So you really need to be reaching out to your professionals, especially about life insurance. It's not a one size fits all solution for everyone. So please reach out to somebody like Jeff or other professionals, especially if you feel like life insurance could have a really big solution for you. because they'll be able to ask your questions, get it really unique, specific to you and your family's needs. So thank you for tuning in today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. If you have any life insurance needs, I recommend reaching out to Jeff and his team at Jones Lowry. His contact information will be included in the information section of this video. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Until then, stay informed, stay proactive, and happy investing.
Thank you.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.